On August 15, 1971, a decision was made that severed the final thread connecting the world's reserve currency to physical constraint. It was not presented as a revolution. It was framed as a temporary measure, a tactical pause in a system that had already been fracturing for years. But temporary measures in monetary architecture tend to become permanent once the benefits of flexibility outweigh the discipline of limitation. What followed was not chaos. What followed was adaptation. And adaptation, when applied to the issuance of money, creates incentives that are structurally difficult to reverse. The Bretton Woods framework had established a clear hierarchy. Currencies were pegged to the dollar was pegged to gold at 35 ounces per unit. This arrangement imposed a ceiling on monetary expansion because every dollar in circulation theoretically carried a claim on a finite stock of metal held in reserve. When that ceiling became inconvenient, when the costs of maintaining foreign commitments and domestic spending exceeded the willingness to defend the peg, the ceiling was removed. The system did not collapse, it transformed, and the transformation introduced a new logic into the architecture of global finance. Without the anchor of convertibility, the value of the dollar became a function of confidence rather than constraint. Confidence is a more flexible metric than weight. It can be managed through rhetoric, through interest rate policy, through military and diplomatic influence, and through the structural dependence of other nations on dollar-denominated trade and debt. This flexibility allowed the United States to run deficits that would have been unsustainable under a commodity-backed regime. It also allowed the export of inflation through the mechanism of reserve currency status. When a central bank prints currency, and that currency is held as reserves by foreign governments and institutions, the inflationary pressure is distributed across the system rather than concentrated domestically. This is not a design flaw, it is a structural feature that has been understood and utilized for decades. History offers precedent. The British pound sterling served as the world's dominant reserve currency throughout the 19th and early 20th centuries. Britain financed empire, war, and industrial expansion through debt issuance that was absorbed by a global network of creditors who had little choice but to hold sterling-denominated assets. As British power waned and fiscal strain intensified, the willingness to defend the gold standard eroded. Britain suspended convertibility during the First World War, resumed it in the 1920s under deflationary pressure, and abandoned it permanently in 1931 when the costs of maintaining the peg exceeded the political capacity to endure austerity. The transition was not orderly. It was accompanied by banking crises, currency devaluations, and a restructuring of global trade relationships. The lesson was clear. Reserve currency status confers privilege, but it also imposes an eventual reckoning when the gap between obligations and resources becomes too wide to bridge through confidence alone. The same pattern appeared in earlier systems. Spain extracted vast quantities of silver from the Americas during the 16th and 17th centuries, flooding European markets with precious metal and fueling inflation that destabilized the very empire that had mined the wealth. The inflow of hard currency did not translate into sustained productivity or institutional strength. It financed wars, bureaucracy, and consumption, while domestic manufacturing atrophied. When the flow of silver slowed, the fiscal structure collapsed. The currency depreciated, debts were repudiated, the empire fragmented, the mechanism is consistent across time. Abundant resources, whether extracted from colonies or printed by central banks, create the illusion of unlimited capacity. That illusion persists until the underlying system can no longer sustain the weight of accumulated obligations. In the modern context, the abandonment of gold convertibility allowed the United States to finance deficits on a scale that would have been impossible under a fixed exchange system. Government spending expanded. Military commitments deepened. Social programs grew. And all of it was funded through the issuance of debt that was purchased by foreign central banks, pension funds, and financial institutions that needed dollar-denominated assets to facilitate trade and manage reserves. The incentive structure became self-reinforcing. Foreign creditors accumulated dollars because global commerce required dollars. The United States issued dollars because foreign creditors were willing to absorb them. And the cycle continued as long as confidence in the system remained intact. But confidence is not static. It responds to fiscal trajectory, to monetary policy, to geopolitical stability, and to the availability of alternatives. The introduction of the euro in 1999 created a rival reserve asset, though it never achieved full displacement due to structural fragmentation within the eurozone and the absence of a unified fiscal authority. More recently, the accumulation of gold by central banks and nations outside the traditional Western alliance has accelerated. This accumulation is not random. It reflects a strategic hedge against the risk of currency devaluation and the potential weaponization of dollar-denominated financial infrastructure. When sanctions are deployed as instruments of foreign policy, they demonstrate both the power and the vulnerability of reserve currency dominance. Power, because access to the dollar system can be restricted. Vulnerability, because the demonstration of that power incentivizes diversification by those who fear future exclusion. The current environment presents a familiar pattern. Debt levels have reached multiples of economic output that exceed peacetime historical norms. Interest payments on that debt are consuming an increasing share of government revenue. Monetary authorities face a choice between maintaining elevated interest rates to control inflation or lowering rates to ease fiscal pressure. Neither option resolves the structural imbalance. Higher rates increase the cost of servicing debt and reduce economic activity. Lower rates risk rekindling inflation and eroding confidence in the currency. This is not a new dilemma. It is the same dilemma that confronted Britain in the interwar period, Spain in the 17th century, and Rome during the 3rd century debasement. The details differ. The mechanism does not. What distinguishes the current moment from previous cycles is the scale and complexity of the global financial system. Derivatives markets measured in hundreds of trillions of notional value create interconnected webs of exposure that amplify volatility and transmit stress across borders with minimal delay. Algorithmic trading and passive investment flows concentrate liquidity in narrow windows and withdraw it just as quickly when risk parameters are breached. Central bank balance sheets that were expanded during successive crises remain bloated, creating uncertainty about the path and pace of normalization. And geopolitical fragmentation is accelerating the development of alternative payment systems and bilateral trade arrangements that bypass dollar infrastructure entirely. Gold and silver exist within this system as legacy assets that carry no counterparty risk and require no third-party validation. They are not dependent on the solvency of a financial institution or the fiscal discipline of a government. This characteristic becomes more attractive when systemic confidence is questioned. The recent volatility in precious metals markets reflects competing forces. On one side, rising yields and a strengthening dollar create opportunity cost for holding non-yielding assets. On the other, uncertainty about fiscal sustainability and monetary policy credibility drives demand for tangible reserves. The result is sharp price swings that discourage speculative participation while intensifying interest among institutional and sovereign buyers focused on long-term strategic positioning. The spread between physical and paper pricing in certain markets reveals stress in the settlement infrastructure. When premiums for delivered metal rise while futures contracts decline, it indicates that financial selling is not being matched by physical supply at equivalent prices. This divergence can persist longer than theory suggests because the mechanisms for arbitrage require capital, credit, regulatory approval, and time. Refineries operate on schedules, vault capacity is finite, import quotas and export restrictions exist, and during periods of heightened volatility, the willingness of market makers to warehouse inventory declines, widening bid-ask spreads, and reducing liquidity precisely when it is most needed. Industrial demand for silver remains structurally firm due to applications in electronics, photovoltaics, and infrastructure that are not easily substituted. This demand does not fluctuate with investor sentiment. It responds to production schedules and technological requirements. When financial markets sell and industrial users continue to secure supply, the price mechanism becomes distorted. Paper markets can trade based on leverage and positioning, while physical markets tighten based on actual consumption. The disconnect creates opportunity for those with patience and capital, but it also creates risk for those who mistake financial volatility for fundamental weakness. Central banks outside the United States and Europe have been accumulating gold at the fastest pace in decades. This behavior is not speculative, it is strategic. It reflects an assessment that the existing monetary order is entering a phase of transition, and that diversification away from dollar-denominated reserves reduces exposure to policy decisions made in Washington. The accumulation is rarely announced in advance. It appears in quarterly reports and annual disclosures, often with minimal commentary, but the volume and consistency of the purchases indicate a coordinated shift in reserve management philosophy that has been underway for years. The historical pattern suggests that transitions in reserve currency dominance occur slowly, then suddenly. The pound sterling maintained primacy for decades after Britain's relative economic decline became evident. The inertia of established systems, the depth of existing financial markets, and the lack of credible alternatives delayed the shift. But when confidence eroded beyond a critical threshold, the transition accelerated. Currencies that had been pegged to sterling were revalued or floated, trade relationships were renegotiated, gold reserves were repatriated, and the architecture of global finance was restructured around a new center of gravity. The current system exhibits similar inertia. The dollar remains dominant in trade invoicing, foreign exchange reserves, and debt issuance. But the conditions that enabled that dominance are eroding. Fiscal deficits are structural rather than cyclical. Monetary policy has become subordinate to debt sustainability. Geopolitical rivals are building parallel infrastructure, and the willingness of foreign creditors to absorb unlimited dollar-denominated liabilities is diminishing. These are not sudden shocks. They are slow-moving pressures that accumulate over years and decades until the system reaches a point where incremental stress produces non-linear outcomes. What remains uncertain is the timeline. Systems can persist in disequilibrium longer than individual participants expect because the costs of transition are immediate while the costs of inaction are deferred. Policymakers, investors, and institutions rationally choose to extend the status quo as long as the benefits of continuity outweigh the risks of disruption. But extension is not resolution, it is postponement, and postponement increases the magnitude of adjustment required when the system eventually resets. The current volatility in precious metals is not an isolated event. It is a signal embedded within a broader pattern of stress in financial architecture that has been building since the removal of convertibility 50 years ago. The mechanisms are visible, the precedents are documented, the incentives are clear. What is missing is the political will to address structural imbalances before they force resolution through crisis. History suggests that will rarely emerges in time, but history also shows that those who recognize the pattern early and position accordingly retain options that others lose when the transition accelerates. The question is not whether the system will adjust, the question is whether the adjustment will be managed or chaotic, and that question remains open.